Shalom, Boker Tov. That's a few words I say in your language. The rest of my speech will be in English. I am very pleased to be there in Tel Aviv, and I will speak about European perspective. But just a few words about our bank, SYSGROUP. It's a Swiss bank created in '96. We are now about 580 people in 21 countries, and there is two business lines, wealth management and asset management for institutionals. We have funds that I manage some of them, and in total we manage about 40 billion of Swiss francs, which makes about 160 billion shekels. So it has been quite successful in the last 20 years in Switzerland. We have grown quite fast. And as I am in Switzerland, kind of, neutral area in Europe, I am very glad and free to speak about European perspective. So I will speak about the economic backdrop, a few words about political challenges that are quite huge in Europe, as you may know, and then also to open the end of my presentation to what are the investment opportunities in Europe. So first of all, I will say that Europe is quite a big economy. Most of the time we speak about Eurozone, but if you look at the whole Europe, you have to include also the UK, Switzerland, and some Nordic countries. So the size of the European economies, actually, when you add all these countries, all these economies, is larger, slightly larger than the US economy. So it's quite diverse. Currently, I think the outlook for the European growth, if you look at the numbers in terms of growth, is not very impressive. European economies are expected to grow, the Eurozone economy is expected to grow about 1.5, 1.7% next year. But what is interesting is that we have a kind of high degree of confidence about this number, which is not the case, for example, of China or US. People, for the last 5 years, they have said, okay, US will grow about 3.5, and most of the time, over the last 5 years, it has been rather 2%. China also, people say 6%, but they are not so sure, because the risks are more on the downside. But for the European economy, what is interesting is that the growth is really domestic driven. It's very easy. We have gone through a few years with a lot of austerities. We have gone through the European debt crisis. And because the level was very low, now it's very easy to rebound. Especially when you have less austerity. European economies benefit from lower oil prices, which is not the case completely for the US, because you have the consumer that are benefiting from lower oil prices, but you have all the shale gas industry, for example, that has problem with the very low oil prices. For the Europe, as we don't have shale gas industry, it's all benefit the lower oil prices. And last but not the least, you have the central banks that is still providing liquidity, which is no more the case in the US, for example. So I will say that, and you will see later, that in the current context of quite weak economic growth in the US, very disappointing economic growth in emerging markets, European economies currently are not so bad. Just to put everything in perspective, and as I said at the beginning, you have many differences between the economies. So most of the time, in the newspaper, in the headlines, you always heard about what is going wrong. But you have also some economies that have done very well over the recent year. So what I have put here, sorry, you have a graph with data in level since beginning of 2005. And I have put as a benchmark the US economy, which is the blue line. And the yellow line is the UK, and the gray line is Switzerland. And I have focused this graph on 4 variables: GDP, economic growth, industrial production, retail sales, and unemployment rate. And you see, for example, that Switzerland and the UK have done quite well, sometimes even better than the US economy over the last 10 years. Especially Switzerland, that has gone through the financial crisis quite well and has been able to rebound in spite of a very strong currency. Industrial production also, that was quite impressive, the outperformance of Switzerland, and that was related to the fact that, as you know, the Swiss economy is a little bit like Israel. It's a small, open economy, so they have benefited fully of the development of emerging market. But you see that recently, as they are very linked to the global demand, industrial production in Switzerland, if you look at the yellow line on here, you see that recently it has been more difficult, and especially with the strength of the currency. Then, in terms of retail sales, that is more about consumers. As you suspect, the UK is very close to what happened in the US. And finally, unemployment rate, the path of US and UK have been quite similar, and in Switzerland, unemployment rate has always been quite low, and it's still below 4%. So that there is a good. Obviously, there is a bad, and also what I call the ugly frites. I don't know if you know in French, frites means French fries. French fries, and you know, people have spoken about the BRIC, Brazil, Russia, India, China, and in Europe we have the fries, France, Italy, and Spain, which are not so good over the last few years. And so you see again the same benchmark. The blue line is the US, and then you have the gray line is the total Eurozone, and the yellow line is just France, Italy, and Spain. Okay? What is interesting by looking at France, Italy, and Spain is that they represent close to 50% of the Eurozone GDP. So it's about the half. And what is nice also, because Eurozone is very different from Germany to Greece, it's not exactly the same. So when you look at Germany, perhaps you have a too nice picture, and when you look at Greece, you have perhaps a too bad picture of the Eurozone. But by focusing on these three large economies, you have quite a good sense of the average of the whole Eurozone economy. So that is quite interesting to see that, and you see obviously that economic growth has lagged. Industrial production has been much lower than in the US. In terms of retail sales, the frites did a little bit better, but because it's, you should know that France, in terms of consumer spending, has been usually quite robust and dynamic because of demographic growth, but also because you have kind of economic stabilizers. So it's very difficult to see unemployment rate going up very sharply. So they have always been in the Eurozone area a play on consumption, France, while in Germany is more a play on production. And that will be quite something that you have to keep in mind, given what I said before. I said before that the current recovery is more linked, it's more domestic, it's more consumption driven than what was the real engines of growth in Europe over the last 10 years, mainly in Germany, and that was essentially producer. So you see in terms of investment, people focusing more than investment on company related to consumption rather than to production. And then you see also in terms of unemployment rate, that has been quite challenging. Unemployment rate is declining, but it's a very slow process. As I said, it's very weak, but in the current context, it's quite good. So here you have the two big sectors of every economy, the manufacturing sectors, and here you have the service sector. And it's interesting to look at that because you have, you know, it's what we call the PMI. You had yesterday some release of the PMI,
was quite weak in China, and it was quite positive in Europe, better than expected in some countries. It was also disappointing in the US. And so how we look at that graph is that, sorry, I will put myself here. You have, if it's above 0, it means that you have an expansion of the sectors. If it's below 0, you have a contraction. And the horizontal axis just gives you the recent trend. So when you are on your right, it means that you have an improvement, a positive trend. When you are on the left, you have a negative trend. And you see that most of the European economies are expanding and with an improving trend, which is not the case, for example, for the US, where you are now below 0 or below 50 for the ISM, and it's deteriorating. Same case in the services industries, where you see that it's even quite strong currently. And again, keep in mind that most of the European recovery, it's not linked with export. Obviously, export have helped, but it's really domestic driven. So the only question now is how long this cyclical upswing can last. For us, we think that at least for the year that is coming, we still have some momentum in this cyclical recovery, so we remain quite confident about European growth perspective for the next 12 to 18 months. Thereafter, it will be much more difficult. And one of the reasons is that it will be very challenging to turn that cyclical upswing into a structural recovery. And what is missing, clearly, it's some investment spending and also some integration in terms of fiscal integration of the Eurozone economy. It's perhaps a little bit small for you, but I hope that you will receive the presentation. You have here all the details about what has happened in terms of economic growth, inflation, unemployment rate, public budget, debt to GDP, and the current account and the level of interest rate. What is common is that interest rates have been low in all the Eurozone economies. I think that the previous speaker spoke about very low interest rate in Israel. It's common also in Europe. In Switzerland, you have to know that the 10-year government bond yields, it's in negative territory. So you pay the Swiss government to own its debt. And that is due, obviously, to very, very low inflation and also to very accommodative monetary policy in the Eurozone, in Switzerland, in Sweden, and even to some extent in the UK, given the current economic growth prospect. As I said, for the euro area, we have an improving trend currently, while for Switzerland and UK, that have been quite a good example so far, we are rather weakening of the trend. In the Switzerland is essentially because of the strength of the Swiss franc and the link to the global demand. Probably the outlook for Switzerland for next year will be less good than it has been in the past. The same for the UK, also with the challenge of the Brexit referendum that will come in the next few months. And obviously I spoke about the political challenges. In Europe we have to deal today with a refugees crisis. That could be a boost because you know that the size of the working age population in Europe, it's declining, so it may be good to have some migrants coming to work and to boost the GDP, but there is the challenge of being able to integrate them correctly. Look at France. I think the integration so far has not been very good, and it could be also a key risk going forward. You have the nationalism and even the regionalism. Look at Spain, what is happening. You have currently a political deadlock. you have Marine Le Pen in France. So that is the key risk, I think, for Europe, is really on the political front, and if we can continue with the integration of the European Union. One of the things that is working well in Europe, in the Eurozone, is the central bank. The only, I will say, institution that really is a European institution is the ECB. And because you don't have a lot of room in terms of budgetary and fiscal policy, most of the burden of keeping the Eurozone together is on Mario Draghi's shoulders. And he did a great job over the last few years. But can it continue to sustain alone all the European project? I don't think so. So again, it will be challenging probably beyond 2016. You see on that graph that credit conditions have improved in Eurozone. You have here credit growth for the household, credit growth for the companies. You have here you have the pickup since the ECB did its quantitative easing and lower interest rate. But you see that again we are much lower than we were before the crisis. So it should continue to support the market. It may continue to cut interest rate and to do more quantitative easing going forward. But that is also important to understand. The European central banks has only one mandate, and his mandate is inflation. It's not like the Fed that has a dual mandate of keeping inflation around 2% and keeping an unemployment rate quite low. The European Central Bank has only one mandate. So one of the key risks going forward for the market will be that inflation goes up in the euro area and expectation of more easing by the ECB disappear. And that could be a risk if suddenly oil prices start to pick up. Don't forget that back in July 2008, the central banks hiked interest rate when we had already signed that economic growth was slowing down. In 2011, the European central banks hiked 2 times because inflation was going above 2%. And at that time, it was a European debt crisis. So that is really a risk. You have to keep an eye on inflation and especially on the oil price. If oil price start to pick up for geopolitical reasons, that could be challenging for a European asset. It's not our scenario, but it's clearly a key risk going forward. Just a few words on Switzerland to say that they have been hit by the strength of the Swiss franc, as I said before. One of the main beneficiaries so far has been consumer, because Swiss people, they go to shop just next the border. It's 20% cheaper than the day before. It's clearly a big boost to the purchasing power, but that is only the short-term impact, which is positive. But now what we are seeing in Switzerland is that unemployment rate is picking up. Some people are losing their job, and the outlook also for consumer spending is going down. So there have been a positive shock for consumption that has compensated for the difficulties of the industries. But for next year, it will be much more challenging, and the economic growth in Switzerland should be just around 1% when it has been close to 2.5% over the last few years. Also, for a few words on the UK, I think if you have to remind about one graph about the UK, remind this graph. That is the current account deficit. And the current account deficit, usually, it's a good indication of the risk that are behind the currency. When you have huge positive balance, as you have in Switzerland, as I suspect you have also in Israel, as you have in Japan in the past, it means that your currency tends to be quite strong, and when you have difficulties on the market, your currency tends to appreciate. Most of the emerging economies, as you may suspect, they have a current account deficit, and when you have crisis, it's the reason why the currency is going down. So look at the UK current account balance. You have a negative current account balance in between currently 6%, minus 6%. So it means that the UK depends essentially on foreign direct investment, on foreign portfolio investment to sustain the value of the currency. So the key risk is in the few weeks we will start to speak about the Brexit referendum, and investors may start to stop to invest in the UK as long as you have uncertainty, and the UK currency could go down quite sharply. My scenario is not that we will have a Brexit. My scenario is that the UK will remain in the European Union project, but ahead of the election, the uncertainties could be quite damaging for the currency. Just before to conclude, just also a few words about Sweden. Very interesting country. It may be the canary in the coal mine. Why? Because the Swedish central bank is doing whatever it takes to avoid deflation. But by doing that, they are boosting real estate prices, they are boosting the GDP, and now you have a GDP growth of about 4%. The currency is appreciating. The more the currency appreciates, the more deflation you will import, and so the central banks continue to intervene in the forex market, continue to do some quantitative easing, and it may be an example where quantitative easing leads to bad result at the end. So there is something to watch going forward, because that may be a quantitative easing that at the end works quite well in terms of economic growth, but not in terms of inflation, and may end in tears in a few months in Sweden if it continues like that. So perhaps just some idea of what we think for next year and what you have to look perhaps in the market. We think that the euro is now stabilized against the dollar. We don't see more weakening in terms of the level. We will remain around 1.10. Be careful about the sterling, the UK currency. In the bonds market, you don't have a lot of opportunities in the govies because interest rates are quite low, but European credit and high yield will be continue to supported by the European Central Bank's monetary policy, so they may have a different path than one you have in the US Treasury market, for example. And for equities, we favor European equities over US equities. However, we advise to go through an active management. It means that you don't have to buy just the index, but you have to find some thematic. So one of them is, for example, what is linked to the real estate market, and what is linked to the domestic recovery. So, for example, try to avoid the producers and try to find some companies that are related to the consumer. One example that I can give you of stocks, it's for example Symrise. They do fragrances, so it's more about perfumes and story like that. It's very defensive business. It's a small company, let's say mid-sized company, not very well known and quite impressive in terms of outlook. Again, small cap also is the same story. Small caps, why? Because they are less linked to the global demand. They are more domestic driven. Usually you don't have a lot of small caps in the energy sectors also. And when you have a merger and acquisition, they are able to benefit from that. You have also many healthcare companies in Europe that are interesting. Novartis, Roche, Bayer. All these kind of company are quite good, and also the dividend story. I think before the previous speakers spoke about dividend. If I take the Swiss market, very easy. I told you, 10-year government bonds, negative yield till 10 years. You take the Swiss equity market, the top 20 stocks, where you have all very good, well-known company. On 20 stock, you have 17 that have a dividend yield higher than 2%. So if I were just in Switzerland, I can just buy Swiss asset. It's clear that many people will tend to buy Swiss equity, because when you have a company like Nestlé, it's almost like a bonds, rather than to buy government bonds. And you have many companies like that in Europe where you have dividend yields that are very appealing, companies that are known quite well worldwide. So I think I already spent too much time with the mic, so
I would like
thank you very much.
I would like to ask you some questions regarding the European markets, and the first one is, what do you think is the main risk? What are the main risks to the European growth?
For the European growth, I don't think there are many risks. I think it's more the risk on the market. As I say, for example, for Germany, clearly China has been on the headlines, especially yesterday. I think China typically is a risk for Germany, for Switzerland, but not for Italy. What is the link between Italy and China? It's just a few brand names, luxury names, but Italian banks, they are very domestic. They don't lend to global players. For economic growth, as I said, I am quite sure that we will achieve these low numbers, but they are quite solid in terms of outlook.
Now, the second question is, how do you see the financial markets in Europe comparing to the US markets?
I think, for once, you have a kind of the most favorable context that you can have for European equities. As I said, you have accommodative monetary policy, which is no more the case in the US, as the Fed is tightening. You have lower oil prices. It's about 10 or 15 years that we haven't seen that. So it's a big money for consumer. It's purchasing power that has increased very fast, thanks to the drop of the oil price. Then you have lower interest rates that are positive for consumer, for the real estate, for example, especially think about country like Italy and Spain. Over the last 20 years, I don't speak about when there was a debt crisis, where interest rates were at 7, 8, 9%. I speak about the last 20 years, you have interest rate above 4, 5%, and now you are 1.5. So it will boost the real estate market, I think even in France. And at the same time, for the government, it's very positive. Italian government will, I think they will save 40 billion over the next 2 years, just because the cost of servicing the debt is much lower than it was in the past. And so for all these reasons, I think in terms of relative performance of European equities versus US, you will have some outperformance. And I forgot to mention that the earnings momentum is much better in Europe, where we expect growth about 7-9%, while we are close to 0 in the US, and valuation also are more interesting. But again, I won't buy the index. I will rather tend to find some stories, specific stocks.
Thank you very much.